banks have to continue supporting their communities. They're there as a resource, as the go-to organization for their community. And there's no doubt that you do a great job at that. And I think that needs to be said, because I think it gets forgotten sometimes that a bank isn't, when you hear about banks failing and the banks are taking advantage, you're forgetting that the banks are there to serve the community, and they do that really well.
Welcome in, everybody. You're listening to Wrestling Payments, a podcast where we help payment professionals contend with the challenges of modernizing their payments operations and identifying ways to build for the future. If you're interested in payments innovation and modernization, you're in the right place. Now, let's get into it.
Hello and welcome to Wrestling Payment. In this episode, we're going to try something a little bit different. This content that I'm going to present is typically presented at the executive level. So it's really high-level topics, really brief, to the point, not intended to take up a lot of time. I might actually take more time talking about it than it would take to read, and that's through our executive summary each month. And this was our February summary, and I had trouble editing this episode because I was so fascinated by the articles in it. I basically went down the rabbit hole of following up on the stories. But for the purpose of this episode, we're going to talk about executive topics and things you may be interested in, things you may have missed, and what it means to our day-to-day operations at financial institutions and money service businesses and the like. So, really introduction to what we're going to talk about. There was a speech. There's often speeches by board of governors at different places. This specific speech we're talking about was given by Governor Michelle Bowman, and she was speaking at the Assembly for Bank Directors, Southwestern Graduate School of Banking in Maui, which I think if I was going to give a speech, not a bad place to give a speech. But during that call, and we're going to talk a little bit more about this, but during that speech, she talked about the risk of complacency is a vulnerability. And as you can imagine, the regulatory burden on financial institutions is large. You know, it balances the position financial institutions are in by all the risk management, the risk appetite, the compliance they have to go through, as well as trying to provide services and continue to grow and continue to innovate. It's a challenge. She talked about being complacent and that vulnerabilities are continuing every day. And she talked about giving feedback, seeking comments on interagency efforts. And when you talk about interagency, we're talking about members of the FFIEC. So that includes OCC, the Federal Reserve, NCUA, lots of different bodies come out with guidances. Not laws, not rules, not regs, but they come up with guidances, and they're looking for interagency or comments on some interagency efforts to reduce the regulatory burden on financial institutions. A little bit more on that later. The next topic that we're talking about, which is really interesting, and I'm pretty much imagine it's not been on your radar unless you are a NEACH member, but recently the Federal Reserve Bank of Atlanta came out with a report. It comes from us, a friend of NEACH, a friend of the Payment Association's, Jessica Washington. And it's the Retail Payments Risk Forum released a paper recently on credit push fraud. And it's, to quote Jessica, she says, these credit push scams called authorized push payment fraud deserve a shift in our curriculum, mitigation techniques and approach to push payment fraud. They deserve changes in our approach to consumer protection. And the final topic we'll cover here, and again, it is an executive summary, but it touches on an article recently from Newsweek with a letter from District Attorney Alvin Bragg of New York. And it's a letter. It is not a regulation. It is not a rule. It is not anything that is implemented, but it is a call to arms and a warning. And his letter is to Venmo, Zelle, and Cash App following a series of fraudulent scams demanding immediate action to protect consumers. Got a lot to talk about there, but let's go back to the beginning and cover the Michelle Bowman's discussion, the future of banking, during her comments of the 157th Assembly of Bank Directors. Just an excerpt from that paper. We find ourselves in an interesting junction in the evolution of banking systems. Some traditional risks, like interest rate risk and liquidity risk, have become a higher priority concern for banks and regulators, while other risks, like cybersecurity and fraud, continue to evolve and pose challenges. And of course, banking regulation and proposed reforms exert pressure on important elements of the banking system, affecting both the size and activities of banks. At the same time, I see important opportunities and a critical need for banks to continue supporting their communities and to find new and innovative ways to deliver financial products and services. If you can get your mind around all that she said there, there's new risks rising, right? Interest rates have changed. Liquidity risks is more prevalent now due to higher interest rates, balance of exchange, inflation, all of those things. That's a thing. She moves on to cybersecurity and fraud, not saying it's gone and less of a risk, but the fact that it continues to be a risk. It continues to evolve and need to be looked at and need to be mitigated. At the same time, which I think is a throwaway line, my personal opinion, not the opinion of the Federal Reserve or anyone having to do with this show, but banks have to continue supporting their communities. Yeah, that's what you guys do. I don't think it's not even a question that banks are there for their communities. They're there as a resource, as the go-to organization for their community. And there's no doubt that you do a great job at that. And I think that needs to be said, because I think it gets forgotten sometimes that, a bank isn't, when you hear about banks failing and the banks are taking advantage, you're forgetting that the banks are there to serve the community, and they do that really well. But then she throws in the idea of innovating or innovative ways to deliver financial products and services. This is a lot when you put it together. The business of banks, if you're not a banker and you're listening to this, thank you, first of all. But the amount of risk aversion financial institutions have, they can't make a mistake. Mistakes literally, not figuratively, not imaginary, literally cost money. These are the institutions that take the responsibility of moving money around, making payments for you, giving you access to credit, to innovating around all of that is very hard. I love that the fact that she's encouraging the community. Before I get too much more into this, I would say that being part of comments, when you're asked for comments from these FFIEC organizations, other organizations that include NEACH, any government organization looking to make a rule change, being part of those comments, the Federal Reserve, being part of those comments is critical to serving your own interests and serving the interests of your community. So I highly encourage you to participate whenever there's a call to action. This call to action was the idea of participating in interagency comments that are out right now. Again, just visit one of the agencies to see what they're looking for and what kind of comments they would like. And in fact, I have a link here. According to the Economic Growth and Regulatory Paper Reduction Act of 1996, the OCC Board, the FDIC, are reviewing agency regulations on identifying outdated and otherwise unnecessary regulatory requirements. So that's what they're looking for right now. How can they eliminate any old, out-of-date regulation? They're going to do that over the next 2 years. And if you're not familiar with the Federal Register, they will be publishing their request for comments in the Federal Register. It's saying that there will be multiple of them. The first one is due by May 6th. So there's still time to comment on what they're putting out. When we look at what the Federal Reserve has done, and Jessica Washington, Federal Reserve Bank of Atlanta, the Risk Forum, they have a paper out right now on credit push payments and risk associated with them. simultaneously, if you will, NEACH is just coming out with new rules around push payments and credit and risk of receiving credits. It's always been a risk of getting debited. The big concern was, are we going to get unauthorized debits, and what does that mean? And it's interesting that this story that Jessica's promoting, and again, I highly recommend it. It's a good read. It's not a hard read. Sometimes you get a paper and it's a hard read. This one is a good read, and I'm sure she would be interested in any of your comments. But it is a new world. If you listen to other podcasts, there are a lot of payment choices out there today, and therefore there's a lot of vectors for fraud and abuse. Literally, my son just fell for one with we're trying to deliver your package. Please pay us for the excess fee. There was no package coming. It was just a scam. That could be true. That was via the USPS, allegedly. And you can get those same things through Venmo, through Zelle, through lots of different vectors. So it's an area to look at, to be concerned about, to be up to date on. I think this paper would be very helpful in just orienting yourself to the topic. NEACH has just come out. By the time you're listening to this, NEACH has probably just come out with rules around credit push risk. So take a look at those as well. And the last one, and I could be talking to myself about being aware of new vectors of attack, but there was a recent article in Newsweek about a letter. It's a letter. Again, it's not a law. It's not a regulation. It's not anything legal, but it is a letter from an important person, right? District Attorney Alvin Bragg, New York, really assertive in their legislation, laws, regulation around payments, around crypto, around money service businesses. So, I wouldn't be surprised if something came out of this, but this is just a letter, and it's super interesting. I was totally unaware of this. And little background, my own personal opinion of things, background before we continue. Payments, faster payments. Faster payments has been a thing for a long time, but the Federal Reserve and the Faster Payments Task Force really looked hard at it starting in 2015. And the idea was, we need to speed up payments. Other geographies, Europe especially, Asia, have instant payments, have payments that were flowing instantly back in 2015. And the U.S. was somewhat behind in that. And so we started looking at it. And one of the things that happens when you start looking at it is, back in the beginning, it was like, we need to take the friction out of payments. We need to make them faster. We need to make all these processes faster. You can probably recall that applying for a mortgage used to be a paperwork-intensive process. And you probably know that things like, and not promoting any product or service, but Rocket Mortgage, for instance, does it online in a few clicks, using whatever they're using. So I personally knew this was coming. I didn't know when it was going to come, but I think it's arrived. And the idea is, we can take the friction out. We can take the friction out. We can take more friction out. And then someone's going to say, whoa. Stop taking the friction out. We need to slow these things down. This letter is in essence, we need to slow these things down. And what it has to do with, and completely unaware of this fraud prior to this letter. The idea is, when we think of, fraud and banking fraud and all this stuff, we think of cyber. I think of cyber. I think of online fraud. I think of someone taking over your app. The risk here, as I understand it, is that folks are being approached on the street. They're being forced into their payment apps and forced to send money to bad guys through their payment apps. So it's literally a holdup in person, not even at an ATM. Wherever that person's phone is, their app is, and they're getting robbed. Let me get a quote from this article. But actually, this section is super short. Let me just read it to you. I'm sorry to read it to you, but I think it's super interesting. It's very brief. If you get our brief ends up on LinkedIn after it's been shown to our member. Take a look. It's very brief, and it covers some really interesting topics. You can certainly go down the rabbit hole like I did, But if you just want to read the brief, it's a good read. In the letter, Bragg said fraudsters gained access to unlocked devices, stealing significant sums of money and using financial information from the app to open new accounts. Despite the company's assurance that the apps were safe, thefts continued to rise. Now, that opinion piece, that's unfair. I think the apps do a good job at fraudulent protection. They onboard you when they onboard you with a limit. You don't know the limit. I don't know the limit, but they've got stuff in the background that does limits. After you've used the app for a while, they increase your limit. They give you access to more money so you can send more money through the app. So it is a concern. If someone's using force against you to open your app, I don't actually know. I guess that's a good point. I don't know what you can do to prevent it. But some of the things, quote, Bragg offered the fintech companies a solution, recommending a series of measures, including multi-factor authentication. Great idea. The article said he also suggested imposing default lower limits on daily monetary transfers and requiring wait times in secondary verification for large transactions, giving users time to identify and cancel unauthorized activity. So I did know it was coming. I didn't tell anyone I know it was coming, so I can't really say I told you so. But I knew it was coming. We're now looking at faster payments, and we're looking at let's slow it down a little bit. I think that's probably the best recommendation there. It's just a letter. It's not a law. The process for these apps is they give you a little bit of access so you can move a little bit of money because they know bad things can happen. Fraudsters get a hold of your information. But then over time, so now let's talk about someone who's a regular user of these apps. Over time, they've opened it up and let you, I regularly transfer money between, siblings or household members. And I get upset when I can't send the money I want to send. So I'd reach a point where it equalizes and we can send equilibrium and we can send money to the folks we want the way we want. Now you introduce a robber, literally a bandit, taking you and holding you up in person and making you send payment. I think it's a great topic to look at, the next level of payments and the idea of how do we bring a little friction back in. This story we could talk about, FedNow, RTP, the big fear, the big article, not part of our, I'm off script now, not part of the brief, which is brief. The big thing about that is when sending money, there's going to be faster payments and faster fraud. I have not heard the big fraud ring or the big fraud mess that has happened. There are restrictions in networks. Maybe they're just too young now to have given the ability for that massive takedown, that Brinks job, if you will, of FedNow or RTP. How do you introduce friction back in? How do you, it's easy to think if you're familiar with these networks at all, it's easy to think of a systemic risk of a transfer to a transfer to a transfer to a transfer within seconds, within a minute. You could have multiple organizations involved, multiple financial institutions involved with a takedown. Haven't heard it yet. Hasn't happened yet. How do we balance the wonders of instant payments, which they're great and they are instant, with security, fraud? I think that multi-factor authentication is a table stakes. I think you have to start there. But, if you're thinking of the scenario with the District Attorney Bragg, multi-factor authentication, all the factors are there, right? All the factors are, if you're holding someone up, all the factors are there. So that's not a mitigant for this type of fraud. The slowdown, maybe there's another sort of confirmation process that could take place, but then now you're balancing against the instantness. So I think I just made that word up, but it's interesting. It's challenging. It is part of, again, we covered this topic in another episode, but it is part of what we need to look at as we continue to offer products to our customers, our members. But that was the brief. Tell me whether you like this episode. We can continue to do episodes like this. And if you like them, I have another version of this, which is the 3 topics version. But this one was the executive brief. Love to hear your feedback on this session.
On behalf of NEACH, your trusted resource in payments, and our guests, I'd like to thank everyone for tuning into the podcast. If you've enjoyed this episode and want to hear more about payments innovation and modernization, you can find the Wrestling Payments Podcast on the podcast page of NEACH.org or wherever you subscribe to podcasts. Just search for Wrestling Payments in your podcast app. Thanks for listening.